Okay, I think we're going to go ahead and get started. I think we have most of the people in the queue right now. I know we'll have a few more that'll be coming in here over time. I want to welcome you to our mid-year market outlook entitled Risks Recoil as the Stock Market Rebounds. Again, we do these twice a year generally. We generally do one in late January, early February as an early year kickoff and outlook and then we typically do one mid-year to kind of do a mid-year check-in, see how we're doing. There's certainly been a lot that has happened in the first half of the year that we want to be able to kind of review with you and then talk about maybe where things might go down the road going forward. So we're going to jump in. And as always, we like to thank our partners at Cetera Investment Management, who headed by their Chief Investment Officer, Gene Goldman, our good friend, and who helped us put together the slide deck and the presentation for today. For those of you who don't know me, I'm Jesse Hurst. I'm a certified financial planner, accredited investment fiduciary, and senior wealth manager and CEO here at Impel Wealth Management. Some of my bio and background information is in here. Kind of interestingly enough, August 87 was when I started in the business. So this month marks 38 years of doing this. This is all I've ever done right out of school, and have had a great time, great career, and a great group of clients to do it with. And joining me for today's webinar is Nathan Olish. Nathan, you want to introduce yourself?
Yeah, thanks, Jess. You know what? I don't think that we've ever really thought about it. I actually started in August of 2013. So I guess we both started in the same months, just maybe a couple years apart,
A
you
couple,
know.
a couple, yeah.
So yeah, I'm Nathan Knowledge, certified financial planner and accredited investment fiduciary and senior financial advisor at Impel Wealth Management. Um, you can see a little bit of my background there as well, but yeah, excited to kick this off and talk about the first half of the year, which has been an interesting one, probably to say the least.
Yeah, yeah. For today, we're going to spend just a minute talk about kind of where we were 6 months ago, what our outlook was. We'll get into the three main themes today. I'm going to review soft data versus hard data. Nathan's going to talk through, what happens as risks recoil or maybe rescind a little bit from what we thought where they were with a lot of the uncertain that we saw in the first half of the year, especially around economic and trade policy. And then we'll finish up with some reasons for optimism. And there are some reasons for optimism here. Just so you know, as we go through this, we will be taking questions at the end. And if you have a question, it's not in the chat. There should be down at the bottom of your screen. There should be, and in mine, it's actually in the More box. If you click the More box, it's either at the top or bottom of your screen. There should be a black bar, and there's a place to click in Q&A. So if you have questions as you go along, things you'd like us to address at the end, Nathan's gonna kind of moderate some Q&A that he and I will talk through so that we make sure we cover your questions and make this useful for you. So we'll remind you at least one more time of that throughout today's session. So let's go back to late January, early February when we did this earlier in the year. We had three main themes for the year at that point, which was one, we thought economic data would moderate, which we have seen. We thought we would see a less friendly Federal Reserve Bank, right? A lot of people were expecting from late last year that the Fed was going to be cutting rates aggressively as inflation fell and economic data moderated. And we said, hey, maybe that wasn't going to be the case. And as we saw again last week with the Federal Reserve Bank meeting, that was not the case as the Fed held interest rates stable for the fifth straight meeting. And we also said we thought diversification would be rewarded, right? That instead of just chasing a small group of high-flying tech and AI stocks, maybe it made sense to be diversified. And if you take a look at those main three themes that we had, 6 months ago, those themes have been rewarded, right? I hate to say, we hit 100% on those, but we came pretty close. And so we're happy with what our thoughts were 6 months ago and how that's played out for the benefit of our clients and their portfolios. As we look forward, we're going to talk about what's the difference between soft and hard data, and what are the data in each of those telling us? Because a lot of times they're not the same, they're not always mirroring each other. We're going to talk about risks recoiling as market uncertainty and maybe policy uncertainty, maybe takes a little bit of a backseat with some of the trade deals being done, with the big, beautiful bill passing. There's more certainty around what tax law is going to be, around what the trade deals are going to look like, and so forth. And what does that mean? And then what are the reasons for optimism going forward? So we'll jump right in here and talk a little bit about soft data versus hard data, and really the divergence in the two sets of themes, right? One of the things that we've seen is that has tariff and trade uncertainty had more impact on soft data. And when you think about soft data, think about opinion surveys, right? Sentiment surveys, consumer confidence surveys, CEO confidence surveys, and so forth. They tend to be more forward looking, but they also tend to be less dependable. If we think about 2022, when Russia invaded Ukraine, and then the Fed started raising interest rates aggressively to combat rising and persistent inflation that they kind of let the cat out of the bag on back in 21, early 22. The sentiment surveys and the soft data went south really quickly and pointed towards a recession that never really came, right? Everybody, if you just looked at the soft sentiment data, thought we were going to have a recession, and then that said, never really came. So, when we talk about soft data, we're talking about surveys for consumers and businesses. And let's take a look at what some of those have to say at this point, right? So as we take a look at soft data, point number one, right? These are the ISM, the Institute of Supply Management surveys, and they do surveys of both the service side of the economy and the manufacturing side of the economy. Um, Anything above 50 tells you that that side of the economy is growing, is in expansion phase. If you drop below 50, it tells you it's contracting. Now, if we went back, to the 1960s, 1970s, 50s, 60s, 70s, manufacturing was a much bigger part of the US economy. If we take a look at it today, manufacturing actually only makes up about 15% of the US economy, whereas services make up a much larger portion of the economy. So you can see here how in 2020, as 17, 18, 19, both manufacturing and services were humming along well above 55 into the 60 range. And then as we headed towards COVID, we saw a downturn in the manufacturing side of the economy, although the service side of the economy still did well. When COVID hit, they both plummeted as the economy was shut down from COVID lockdowns, stay-at-home requirements, and so forth. But then as the CARES Act passed, the Federal Reserve Bank cut interest rates to zero, and we had multiple rounds of various stimulus that were thrown at the economy. These things that dropped dramatically rebounded just as dramatically in late 20 into 21 and 22, which is where we saw the economy get hot and inflation ignite. And then again in 2022, as we got into the Russia invading Ukraine and the Federal Reserve Bank raising interest rates at the fastest pace they had done in 40 years, you saw the manufacturing side of the economy go into contraction and barely break above it towards the end of last year. But for most of the last 3 years, the manufacturing side of the economy hasn't done very well, but a lot of it's been offset by the service side of the economy, which, like I said, again, is 85% of the economy. staying above 50. Today, the ISM number came in. Nathan, did you see that? It was right at, I think, 50.1
Yeah,
was
just over
was the
50.
number that the ISM services side came in today. It was expected to rise to 51. I think it came in at 50.1. So literally right on the teetering there between expansion and contraction, right? The second, one of the other things that they asked within this survey is what is your outlook on inflation? So this is the price index. They look out and say, what do you think is going to happen? Where do you expect prices to be 1 year from now? And you can see again, prices plummeted. The expectations for prices plummeted during COVID, shot up dramatically with the post-COVID stimulus and interest rates going to zero, which again is what led to inflation going up to 9% in June of 2021. I'm sorry, June of 2022. And as the Fed was started raising interest rates, we saw those inflation expectations moderate more so on the good side of the economy than the service side. But then one of the things you'll see, and I'll address this again later in our towards the end of the presentation, is that inflation expectations shot up, in the face of trade tariff uncertainty. The one thing that I will say, and by the way, this is what producer prices are, wholesale prices. This is what manufacturers pay for prices, which ultimately leads into consumer prices. The one thing that I would say, and I'll come back and address this again, there was a substantial difference in these sentiment surveys around the what was going to be paid for higher prices based on whether you were a Democrat or Republican, right? And just like so many things in this country that are somewhat divided, right? We saw that people on the Democratic side of the aisle thought that inflation was going to spike 9-10% higher than what it was back here in 22, 21, 22, while Republicans thought it was only going to be 1 or 2%. Again, like most things, it's going to be probably somewhere between those two extremes. But there was significant difference in the answers to these surveys based on political affiliation. There was a second inflation expectations survey that comes out every month from the University of Michigan. They put out a consumer sentiment survey, and one of the questions they ask is about inflation expectations. And again, you can see that inflation expectations, which were anchored down around 3% year over year CPI growth, shot up to 6-7%. But again, it was the same thing. If you were more left leaning, it was a much higher number. If you were right leaning, it was much lower, and the number was ended up being in that 6-7% range. You can see as some of the trade deals have gotten done and some of the trade tariffs uncertainty has dissipated, that expectation has started to come back down, although it's still elevated above 5 at the present time. The other thing that we saw was just basic US consumer confidence, right? Consumer confidence after the 2016 election shot up dramatically. And by the way, in this, the green line is your present situation. The yellow line is what you expect over the next coming year. So it's interesting that generally, and this goes back decades, right? This goes back to the late 90s through the tech.com bubble, through the real estate bubble back here in 06, 07, which led to the subprime mortgage crisis and the failure of AIG Lehman Brothers, heading right into COVID. And even now, you'll see that where people are today, people feel better about where they are today than where they think they'll be a year from now, right? People tend to be more pessimistic about the future. I believe a lot of that has to do with the news and social media people consume, right? And that's whether it's CNN, MSNBC on one side or Fox News on the other side. There are a number of news sources. If you go to the blog page of our website, I wrote a blog post a couple months back. I think it was in June it came out about is optimism rational? And I gave a number of news sources that people could go to give them a better, more balanced view of where the world is going and reasons to be optimistic based on what's happening with the pace of advancement in technology and AI advancements and what it means to a whole host of areas. But you can see that over the last year, even how people feel about their present situation has moderated, but is still positive above the long-term average. But people have a much more pessimistic view about where things are going. Now, here's something that I find very interesting in all of this is that as we flip to the last couple of slides here before I turn it over to Nathan about hard data, right? So over the last several slides, you'll see here on the upper left-hand side, these are all soft data points. As we move to hard data points, which is something you can actually measure. The first one we're looking at here is consumer spending. So as you take a look at consumer spending, you can see that while people feel that the future is not great and they feel that inflation is going to be higher, they haven't changed their spending habits at all. Like consumer spending has just kind of trickled along here, 23, 24, 25, right along this long-term trend line of 5.4%. So a lot of times there's a difference between what consumers say they feel and how they actually spend, and this is a great example of that. One of the one of the great speeches I ever saw was in the wake of the 0809 financial crisis, the subprime mortgage crisis, where Dr. David Kelly, who's the chief economist at JP Morgan Chase, still is today, who was born overseas. Nathan, I never remember, is he Scottish or Irish?
Oh boy, I think he's Irish.
I think he's
Pretty sure
Irish,
he's
yeah,
Irish.
right. And
Yeah.
he's got the thick accent, and he said that he stands in awe of U.S. consumers that no matter what happens, they still spend money. And he said not only do they spend money, but they still think they need to spend money on more stuff they need to buy, right? And it's like you see that here, right? Even if they say they're worried about inflation and they don't think the future is bright, it doesn't really change their spending habits over time. Another thing that we saw here in the hard data side of things is while there was great concern that manufacturing was going to fall off a cliff because of trade tariff stuff, actually manufacturing did very well early in the year, January, February, and so forth. Now, some of that in reality may have been manufacturing to front run and buy things before tariffs went into place. But after a temporary dip here in April, things rebounded in May, and anecdotal evidence kind of points towards the fact that with some of these trade deals being done with Japan and South Korea and the European Central Union and so forth, right, that manufacturing is picking up steam once again. So there hasn't been the massive drop off that people expected. And then the other big thing, and I do have to say that, when we put together these slide decks, they're put together in late June, early July. And so some of this data, by the time we get to do it 3, 4 weeks later is a little bit stale. This is something called the JOLTS report, the Job Openings and Labor Turnover Survey. It is the second employment report that's put out by the Bureau of Labor Statistics every month. Everybody pays attention to the report that came out last Friday, which was the unemployment report, because it tells what the unemployment rate was, and it tells, it also tells, how many jobs were created. The JOLTS report, or the Job Opening and Labor Turnover Survey, actually measures the number of jobs that are available versus the number of people who are out looking for work. And you can see after this massive COVID drop off, we got up to a point in 22 where there were 12 million jobs available and there were only about 5.8 million people looking for work. So there was literally 2 jobs available for every person looking for work, which meant that employers were competing for the people they wanted to fill their jobs, which leads to wage inflation, which fed into overall consumer prices. Over the last few years, we've seen the number of job openings go from 12 million to about 7.5 million, while the number of people looking for work has gone from about 5.8 million to almost 7 million. So it's almost 1 to 1 now, which has more evenly put the labor market in more balance. And even though the jobs number came in under expectation with negative revisions last month, the unemployment rate rose from 4.1 to 4.2. And if you look at the last 12 months, most of the time the unemployment rate's been between 4 and 4.2. It really hasn't changed much. So while from month to month it could certainly change, over time, one month does not a trend make. So if you look at it over the last year, that trend's been pretty stable. So with that, I'm going to turn it over to Nathan and let him talk about what the risk outlook side of the economy looks like.
Thanks, Jess. Yeah, so the second theme that we're gonna talk through is, what's happened now that we've kind of gotten through the first half of the year and we saw some of the hard data, the soft data numbers out there. And if you go to the next slide, Jess, I think it's actually interesting where you can see on the S&P 500, right, which is the chart here. If you start there and kind of go towards the upper right hand side, you can see where on the U.S. stock market side with the S&P, it peaked out on February 19th of this year, and then slowly started down, and you can see on a closing basis was just short of 20%. On intraday basis, it just eclipsed that mark, and a lot of that was driven that pullback was due to a lot of the uncertainty around trade policy, tariffs that were may or may not going to be implemented. And I think a big piece of that is the markets and the CEOs and CFOs who are trying to make plans for their businesses, right? The companies that make up the S&P 500, that uncertainty that they may have because they don't know what the exact policies that are going to be put in place led a lot to the fear that created the downturn, the initial downturn. But then the market bottomed on April 8th, and when the tariffs were then paused, ultimately, the 90-day pause by President Trump, then we saw the rebound. And as Jess pointed out earlier, this chart is as of June 20th. And if you've paid attention at all, maybe any time here in the last 45 days or so, we know that the market has actually now gone on to make a new all-time high. It was a touch over 6,400 on the S&P 500, just a week and a half ago. So as we got a little bit more clarity and some of the trade deals did get pushed through, some pretty major ones got pushed through, and as we've seen maybe some of those fears around the tariffs at least abate a little bit, the market has certainly rebounded here very nicely. And if you can go on to the next slide.
Hey, Nathan,
Yeah.
I was just thinking about the conversation we had with a client earlier today, and whoops, one of the things, I'm sorry, I had a screen pop up on me here. So what, if you think back to April 8th, right, and you think about where things were at in the market and how fearful people were at that moment, right? Stock market dropped 20% in just a few weeks. We
Yeah.
were told that it was the fifth fastest 10% drop in the market in the last 75 years. There's all sorts of trade tariff uncertainty, and people are afraid it's going to cause massive inflation, massive economic slowdown, massive job loss, and so forth. If you had told to anybody on April 8th that over the next 90 days, right, that we would have had, continued trade tariff uncertainty, we would have had all kinds of uncertainty around inflation and the Federal Reserve Bank policy, and even
Yeah.
whether Jerome Powell was going to stick around as Federal Reserve Bank chairman, right? We had all kinds of uncertainty around tax policy and whether or not the big beautiful bill was going to get passed. And oh, by the way, in the midst of all that, we're going to drop a few bombs on Iran's nuclear facilities. but don't
Right.
worry because 90 days from now, stocks will be at an all-time new high. People would have looked at us like we were crazy.
Yeah, I agree. Yeah, I mean, I think that's part of, why we speak so much to sticking to the plan, staying invested through those times of short-term uncertainty and short-term volatility that we just try to generally remind our clients of, hey, um, history doesn't repeat itself, but it often rhymes, right? And certainly through your career in mine, which is not as long, like we've lived through lots of periods of uncertainty before, but we stick to our plan. We for those of our clients who are retired, those of you who are on the call that are retired clients, you know that we tend to stay 2 to 3 years ahead in terms of liquidity. So we don't have to necessarily to respond emotionally to something that we can't control, right? We can't control the ups and downs of the market. I like the analogy, I still use it all the time of, we know long-term investing is like walking up a mountain while doing a yo-yo, or having the yo-yo go up and down. So we certainly watched the yo-yo go up and down from February to first week of April this year, and now have come out the other side of it. So the next chart here, yeah, shows the rebound in valuations, and as the market fell and rebounded, so have market valuations. And this is forward-looking price to earning ratio on the S&P 500. So this is the current price, I should say, excuse me, of the S&P 500 divided by the estimated earnings. And you can see, the market from a historical standpoint is higher than the average, right? The average there is 18 and change. We're 21 and change today, which in some ways you may say, well, does that mean that the market may be overvalued? But the one thing that sticks in my head, one of the investment strategists that we follow says, the market may stay overvalued longer than you can stay solvent, meaning, we do want to pay attention to it, right? We don't want to get out over our skis and necessarily overpay in terms of if the market is expensive on this metric, we just got to pay attention to it. But you also can see periods of time through here, right? If you look at this chart, if you were to say, oh my goodness, back in 2020, 2021, 20, like the market is expensive because the green line's above the dotted gray one. Well, we don't necessarily want to get out, right? Just because of that. So it's just something to keep in mind, and I remind clients that this is forward looking. So we're taking the current price against estimated earnings, right? It's an estimate for a reason. It's not like it's set in stone. So there's something we pay attention to, but the market has certainly rebounded after the drop we experienced earlier this year. On the next slide,
By the
which
way, Nathan, one of the
yeah,
things that I saw, not to jump in here again, but I just saw this morning. I was looking at reporting information on second quarter earnings from FactSet, which is one of the
hmm
firms that we use that tracks earnings reports. And I guess my tie right into this was that on June 30th, the projected earnings for second quarter that are just now being released was 4.9% for the second quarter with two-thirds of the companies reporting it's at 10.3% or double. So
right.
that's why they're estimates,
That's
right?
why they're estimates, right? And one of the things that we always are cognizant of, is sometimes companies, especially when they don't know, when there's some uncertainty. I don't want to say that they're juicing the numbers necessarily, but if there's uncertainty and they don't know, then their projections, which are what's shown on this slide, and this is as of June 12th, they may project low, right? It's kind of like you don't want to overpromise and underdeliver. So sometimes their projected earnings are lower than what the actual numbers may come in at, which is to Jesse's point there about, the projections were shown significantly lower than what have actually come in, at least so far, right? On that. So one thing to pay attention to though for sure is I think one of the things that's key is earnings growth are projected negative, right? So if we see then that becomes potentially problematic. But as of right now, you know, growth is growth, whether it's 4%, 8%, 10%. You know, right now in general, companies are still projecting that they're going to have growth to their earnings. And we know that if companies have growth to their earnings, then typically that's what ultimately drives profits, and that's what drives stock prices. So there is some reason there to be optimistic. The next slide talks a little bit, Jess, you hinted at it, right? About just so far this year, we had all of the tariff uncertainty that we've already talked about. We had uncertainty around tax policy and the one big beautiful bill. We had uncertainty with the Fed. Is the Fed are they going to be friendly in the notion that are they going to cut rates or are they going to hold them steady? We had the geopolitical risks with the conflict in the Middle East between Iran and Israel. So all of those things led to some risks certainly earlier this year. So when we look at the next slide shows about the tariffs, the uncertainty around tariff rates, which just shows the implementation of all tariffs and then the effective rate on them. And it's still showing that the tariffs have driven some of the uncertainty of the markets, and we still think that they likely will drive some of them. If all of the tariffs were fully implemented, then obviously it would potentially drive the rates much, much higher. But so far, we haven't really seen them be implemented at the rate at which they may have initially been stated. So I think that's something to keep in mind. You may or may not love the negotiation tactic, but often it may bring a country to the table if there's some fear and uncertainty that there may be some discord around trade deals with the United States. So I think what we've seen so far is that the impact of tariffs has not quite been as bad as what many thought they were, not necessarily what many thought they were going to be. And we still certainly do see some uncertainty here that hasn't come in yet. And then the last
Hey,
slide before.
Nathan, one thing that you and I spent a lot of time back in May watching the Strategic Investment Conference from Malden Economics, right?
Yeah.
And there were more than 20 speakers over 5 days, some of the brightest minds in the world, including a guy by the name of Barry Habib, who's been the number one rated real estate economist, 4 of the last 7 years by Zillow. And one of the things he talked about that I know you saw this presentation
Mhm.
was the difference between tariff rates and what it actually means on retail goods, right? Like if somebody imports if a manufacturer exports something to the United States that costs $10 to manufacture, and there's a 20% tariff on that, or yeah, 20% tariff on that, that's $2, 2 out of 10. But if then there's the wholesaler brings it in, marks it up, and then the retail buys it and marks it up and sells it for 30, people go, oh my gosh, it's a 20% increase, 20% increase on the $30 item, but it's actually a 20% increase on the $10 cost of goods sold, which is $2, not $6. So
Right.
$2 out of $30 is like a 6% increase, not a 20% increase.
Yeah.
So that's part of why I think the net impact hasn't been as bad as what people maybe thought when they first heard it, right?
Yeah, that's right. Yeah. Yep. So, and the last slide here looks at high yield spreads in the high yield bond market. And one of the things that we pay attention to here on high yield spreads is you can see those gray bars are historical recession. So you've got the one that was around that happened after post 9/11 going into failure of Enron WorldCom. You've got 07, 08 during subprime mortgage crisis, failure of AIG and Lehman Brothers, and then the COVID induced recession. And in all of those cases, we saw the spread on high yield bonds go higher, right? You can see that green line go higher, which when they go higher, typically that means that there is some fears around there's a potential of a recession. And when it gets wider, when that green line goes up, then you typically see bonds fall in price. Well, you can see so far there was a very, very brief spike upward there. Did not even get above the average of the last, almost 30 years is what this chart shows. There was a brief spike up earlier this year. That was in the April time period around fears around the again what was going to happen with the tariffs. But since then, a lot of those fears have abated, and the number has come back down, which means that at this point in time, at least from the bond market standpoint, there's not really a signal that there's an impending recession at this point in time, according to when you look at the bond market, which has been, it's been a pretty historically reliable indicator. You can look at the chart and see that when you see that number or that line go up above, it actually there was a very brief false signal in 2022, which is what Jesse was alluding to earlier at the beginning, talking about soft data. All the soft data numbers were so bad, and everybody thought, oh my goodness, there's going to be a recession, and high yield spreads started to go higher. But then it wasn't as bad as what we thought it was going to be, and the recession didn't materialize. But still, as of right now, high yield spreads are not indicating that we are headed towards a recession, at least not in the immediate future. So
Yeah, I was just looking up because I know we're jumping into the last couple points that I had here for reasons for optimism. I was just looking up because as you were talking about the bond market being a pretty good indicator, back in the late 90s, James Carville, when who was the political guy that helped put Bill Clinton in the office. He said he used to joke that he wants to come back. He said he wants to come back as the bond market. He doesn't want to, if he was reincarnated, he doesn't want to come back as the president or somebody like that. Rather, he'd want to come back as the bond market because you can intimidate anybody because it has
yeah,
more power than just about anybody,
yeah,
right? Which
yep.
is interesting, right? And you think about it, um, you go back to that chart. I won't scroll back to it, but that showed what happened with the stock market this year, right? That 20% downturn. And when Trump kind of pushed, by my opinion, from everything I've read, by Secretary Bessent, Treasury Secretary Brett Bessent, to put the 90-day pause on the tariffs, a lot of that didn't come from just the stock market falling. It came from fear about what was going
Bond
to happen
market.
with the bond market and the
Yep.
treasury market, right?
Yep.
And a lot of people say, hey, and the same thing happened in 2009, right? In March of 2000, February, March of 2009, the stock market was still spiraling down, 4 or 5 months after the failure of AIG Lehman Brothers. And at that point, President Obama was talking about nationalizing the banks, and the market just revolted. And Obama backed off his policy, and the market rebounded. And you look at it and you go, the market was what drove Obama to change his policy. The market was what drove Trump to change his
Mhm.
policy. And sometimes it's the bond market that has more power than the stock market in that process, right?
Yep. Yep.
So that's going in the Wayback Machine a little wise. But like I said, this is 38 years I've been doing this. I remember, I lived it. So as we talk about reasons for optimism amidst the uncertainty, there's a number of reasons for them, and we're going to talk about what some of them are here. And then we're going to go to Q&A. So I know we have 3 or 4 questions in the Q&A queue. If you have any, again, hit the bar at the bottom or top, the black bar. And if there's not a Q&A button, hit the more button and you'll see it in there. You can add your Q&A and then we'll answer those in just a few minutes, right? So what you see here, reasons to be cautiously optimistic, right? You see soft data being weak, and you sit there and go, well, why is that? Why is that a reason to be optimistic? Well, sometimes that's a contrarian indicator, right? Sometimes you hear this in the market, right? And one of the great examples was Friday to Saturday or Friday to Monday, right? On Friday, the jobs market came in weak, and bad news was bad news, and it caused the stock market to go down. But by Monday, the market realized that if the job market really is weak, the Fed will have to cut interest rates. So bad news was good news, and it caused the market to go up on Monday, and the market went up on Monday more than it went down on Friday. So it's just interesting, right? The political bias we talked about in those soft sentiment surveys, the inflation surveys, the sentiment, the confidence surveys. There is a significant bias in there, and the same thing is true when Biden was in office. Republicans looked at things worse than Democrats did. When Trump's in office, Democrats look at things worse than Trump did. But that leads to them having lower predictive power than maybe what they used to do in the past. So. Um, Inflation seems to be under control. So this is kind of interesting. If you look at the 5 months of consumer price index since Trump's been in office, the 5 months equate to a 1.8% annualized CPI number, which is under the Fed's 2% target. The reason the year over year number is still kind of in the 2.5% range is because of some bad numbers. You got to remember that the CPI number is the combination of 12 monthly numbers. So when the August number comes out, when the August of 2025 number comes out, the August of 2024 number rolls off. So it's a rolling 12 months. So we've got a few bad months of data from late summer, early fall next year that will fall off, that will likely, along with housing prices coming down and energy prices coming down, we'll see that maybe inflation is not continuing to press forward as much as maybe what people thought, right? We also are cautiously optimistic. The hard data is moderating. We've seen manufacturing slow but not roll over. We've seen employment slow but not roll over, right? They if you think about forward-looking indicators, the weekly jobless claims numbers, uh, which had gotten up to about 200, a little over 240,000 2 months ago, have moderated back down towards 220,000 a week. Same thing happened a year ago. As a matter of fact, I'm just going to pop off here for just a second, right? Thinking about a year ago, right? Like they always say, history doesn't repeat itself, but it sure does rhyme. If we went back to July a year ago, on a Wednesday, the Federal Reserve Bank came out and said, we're not cutting interest rates. We're going to leave interest rates where they are. And 2 days later, on that Friday, we had a bad jobs report. And all of a sudden, the following week, all kinds of economists and market strategists were calling for an immediate intra-meeting Fed rate cut. And so here we are 12 months later, and last Wednesday, the Fed doesn't cut interest rates. On Friday, we get a bad jobs report, and all of a sudden, the odds of a Fed rate cut in September on Wednesday when the Fed met was like 44%. By Friday, it was 81%, just because of that, right? So it's interesting. It was almost identical to what happened a year ago with that. So, anyways. Tariff negotiations are in everyone's best interest. Everybody knows that. And I think part of the reasons you've seen the markets not freak out so much as we've gone through various iterations of trade tariff announcements is everybody realized, hey, even though Trump started at 30 or 35 or 40%, whatever, for a lot of countries, that was a negotiating tool. And, what Trump says and where things end up might be two different things, right? It looks like we're getting more clarity about the eventuality of Fed rate cuts. It looks pretty much, unless we see some massive economic turnaround in the next 4 weeks, that we'll get a Fed rate cut in September. Markets are now pricing in a good chance, a high probability of two rate cuts, and we're starting to even getting a chance at a third rate cut this year, which would be September, October, and December, which would mean that the Fed goes from being a foe to being a friend again. And then market implications from geopolitical events may be short-lived. I know shared this chart in the past before, but you can see when we have geopolitical events, right? Kuwait being invaded by Iraq, the Oklahoma City bombing, right? The 9/11 events and so forth, that you can see while the typical initial response is down, that doesn't necessarily mean that 1 month or even 1 year later that you have a down market, right? The only times that you really saw a down market a year later was when you had a significantly slowing economy already, right? 9/11 had happened on the heels of the dot-com bubble bursting, so you already had an economy that was slowing. Russia invading Ukraine was happening as inflation was rising dramatically and the Fed was starting to raise interest rates. But you can see that just because you have a geopolitical event, a lot of times there's a knee-jerk reaction down followed by a strong rebound. So we're not saying that everybody should be optimistic about everything all the time, but maybe things aren't as bleak as what maybe the media likes to portray it. Remember the media's mantra, if it bleeds, it leads, right? So the media, if you take a look at the number of negative versus positive news articles in the press, it's overwhelmingly negative because that's what draws clicks and viewers and so forth. So with that, we're going to hit a few Q&A. Just remember, how we can help you going forward. We've got our weekly blog posts. We generally do two a week. We've got, we lead with financial planning. We think financial planning is the key. That's kind of the North Star that guides everything that we do. We provide the fiduciary fee-based portfolio management. And when you go back to the commentaries and blog posts, just a shameless self-plug here, right? We write a lot of blog posts. I think I've written about 600 of them over the last since 2020. And I do have my first book coming out here on September 4th. So you'll stay tuned. You'll see more news about that coming up. So with
Well,
that,
that answers
Nathan,
one of the questions, or close to it at least.
go
One,
ahead.
one of our three questions is when are we going to be able to order your book?
Oh,
So
okay.
somebody must have seen the email that we sent out earlier today from our
Yeah.
office to
Yeah,
save the date. So
we sent out a pre-announcement on the save the date
yeah.
for the book.
So
So
the
the
first
book,
question is, yeah, when will we be able to order your book?
yeah. So the book is called. We should have thrown a slide in here on the book, but the book is called Poponomics. For those of you who are familiar with most of the blog posts that I write and so forth, a lot of times I think it's more fun and more memorable for people to read if they're tied to some pop culture reference, movies, music, TV shows, Broadway musicals, whatever. So, the book is about solving your retirement puzzle by looking at financial, retirement, and investment issues through a pop culture lens. So the book's coming out September 4th. It will be available on Amazon and a few other Barnes and Nobles and a few other places. If you actually Google or look on Amazon for Poponomics, you can pre-order it now. It's only available. The Kindle version is only available now. The soft cover and hardcover will be available on September 4th. So,
There you go. Good. The next question, it's a good one. It says, what are the major benefits from the One Big Beautiful Bill, and can those of us over 65 benefit from it?
okay, good. Great question. So, I'm going to pop off here so Nathan and I can talk about this, right?
Yeah.
So one of the things that the Big Beautiful Bill did was it increased the standard deduction for most people. And by the way, the Tax Cuts and Jobs Act of 2017, which was passed in December of 2017 and went into effect January 1 of 2018, put into effect lower tax rates for everybody other than those in the 10% bracket, right? The 15% bracket went to 12, the 25% bracket went to 22, and so forth. The big beautiful bill extended those tax brackets permanently into the future. The Tax Cuts and Jobs Act also significantly increased the standard deduction. So before the Tax Cuts and Jobs Act, something like 40% of all people itemized deductions.
Mhm.
Today it's like 12%. Almost everybody files a standard deduction. So that standard deduction was increased to $31,500. If you're over age 65, you get an additional $1,600 per person. So for a married couple filing joint, that's another $3,200, or it takes the standard deduction for retired couples over age 65 to $34,700. And then what it did, Trump talks a lot. If anybody watched his interview on CNBC this morning, Trump talks a lot. He talked a lot on the campaign trail about cutting taxes on Social Security. Because they passed the bill through the reconciliation process, you cannot change Social Security through budget reconciliation. It would require 60 votes. So what they did was they added a $6,000 per person above the line tax deduction for people 65 and over. And now remember, this is only for the next 3 years, right? So you get the 31.5, you get the extra 1,600 per person that takes it to 34.7, and then you get, if you're over age 65, $6,000 per person, or another $12,000 that you can deduct above the line deduction. So that takes us to what, 46,700,
Yeah.
which means the first $46,700 of income as a retired person. And remember, you only pay tax on a maximum of 85% of your Social Security. The first 46,700 of taxable is taxed at zero now. Now that 12,000 or 6,000 per person, 12,000 per couple is only extended for the next 3 years through the end of Trump's term. However, as Ronald Reagan used to say, there is nothing so permanent as a temporary government program, right? Like once you give it to somebody, it's really hard to take it away. So we shall see. So if you have 47,000 of standard deduction and extra benefits, then you've got up to $97,000 currently in the 12% bracket. So married couples filing joint will be able to have almost 143, 144,000 a year of taxable income and stay in a 12% bracket. The first 46,000, 47,000 is going to be taxed at zero, the next 24,000 at 10%, and then the rest of that up to 12. So that means retired couples can have almost $12,000 a month of taxable income and stay in a
Mhm.
12% bracket. And by the way, if you stay in a 12% bracket, capital gains taxes are zero. So there are substantial tax planning opportunities that we have for people 65 and over going forward for at least the next 3 years.
Yeah, I think on a that yeah, that's all. It's all great. And I think one of a smaller one, but still kind of an important one for a lot of our clients is um, there's now an above the line deduction up to $2,000 for married couple, 1,000 for an individual, regardless of whether you itemize or not for charitable giving as well, right? So a lot of
Yep.
our clients who do give, because one of the things in recent years, there's there's been you wouldn't get any tax break in the last several years unless you were itemizing your deductions, which meant you had to be over that standard deduction threshold, which was up above $30,000. So, for a lot of clients, if they give, three, four, $5,000 a year to their favorite church or charity, or then maybe they weren't getting any tax deduction for that. This will allow people to get some deduction there as well.
And,
So,
and Nathan, why don't you remind people why we do what we do with our clients who want to do charitable giving who are over 70 and a half?
yeah, so if you're over age 70 and a half, which I know is a funky age, but you have to have achieved age 75 or 70 and a half. Once you reach 70 and a half, you can do what's called a qualified charitable distribution, which means You can take money out of a traditional IRA that you have not paid tax on, right? It's money that you put away into a 401k or what have you, pre-tax. And then once you reach 70 and a half, you can take the money from your IRA and give it directly to the charity, and then nobody pays tax. You don't pay tax on the money that goes to the charity. And because the charity is a 501c3 tax exempt organization, they don't have to pay any tax either. So it's really a smart way for those who are 70 and a half or older to give money out of their IRAs, and then nobody pays any tax on the giving. So
Yep. Yep. All right. I know we're coming up right on time. We got one last question and then we'll close.
yeah, the last one is transparency around the recent jobs report that's being criticized. Can you give us some transparency on the recent jobs report? That's
Yeah.
so.
Yeah, the jobs report, um, it was the largest revisions for a 2 month period in 25, 30 years, right? So it's natural that people would look at that circumspect way. There's a number of reasons for that. If you remember last year, the Bureau of Labor Statistics twice a year does benchmark revisions to the jobless claims. And, while they were telling us for the first half of 2024 that the economy was booming and we were creating all of these great jobs, then later in the year they told us, oh yeah, 818,000 of those jobs didn't really happen. And part of this is all coming from, and you don't see anything written about this. Dr. Jeremy Siegel from the Wharton School of Business spoke about this yesterday on CNBC. You can look it up on YouTube. But he did talk about the fact that one of the problems that the government's having right now is in collecting data. These
Mhm.
surveys are not required. There's no carrot to no incentive to do it, and there's no sticker penalty if you don't. So what they're finding is the survey return rates now have dropped to like 60%. And on the JOLTS report that I mentioned earlier, it's down to 25 or 30%. So
Mhm.
they're trying to interpolate data that they're not getting, and it's leading to misses. And so you can criticize a person, which is something Trump likes to do whenever something goes wrong. Or you can look at the institution and the policies and go, what do we need to do to fix the system?
Mhm.
But either way, the numbers were wrong and they were off by bigger margins than we had seen in a long time. So
Yep.
yeah, that's
Yep.
probably the easiest way to say that without getting overtly political. But
Yeah.
anything else in the queue, Nathan?
That's it. Those were the three. Those were good ones, though.
Yeah, good question. So, all right. Well, listen, we're right at time, right at 4:59. We always, as always, appreciate again Gene Goldman and his group at Cetera Investment Management. We always appreciate our team at Impel Wealth Management, and we always appreciate you, our friends and clients, and attending and finding value in this. So we appreciate it. We look forward to seeing you soon, and have a great day. Thanks. Bye bye.